ask you something. How much money did you spend last week? On gas? On groceries? On your mortgage? On the 401k contribution that quietly left your paycheck before you even saw it? Do you know where that money went? I mean, do you really know? Most people, smart, educated, hardworking Americans, have absolutely no idea how the money in their lives actually moves. And that lack of understanding, it is costing you every single day. Right now, count 5 seconds in your head. Think about the last financial decision you made. Did you truly understand the market forces behind it? That discomfort you just felt? That is exactly why we are here today. I'm Hannah from Finance Lab Global. For over 30 years, I have sat in rooms with some of the most powerful investors, central bankers, and CEOs on the planet. I have managed portfolios worth billions of dollars. I have walked clients through the 2008 financial crisis, through COVID market chaos, through every bull run and every crash you can name. And in all of that time, in every boardroom, every investor meeting, every crisis call at 2 a.m, I have seen the same pattern over and over again. The people who win in financial markets are not necessarily the smartest. They are the most informed. And today, in the next 60 minutes, I am going to give you that information. I want to tell you about a woman I met at a conference in Chicago. Call her Sarah, 34 years old, marketing manager, making good money, contributing to her 401k. She came to me after a panel and said, "I keep hearing about bond yields going up and stock prices going down, but I do not understand why." And I said, "Sarah, by the time I explain this in simple language, your entire financial worldview is going to shift." That conversation lasted 45 minutes. She later told me it was the most valuable financial conversation of her life. Today, I am going to have that conversation with all of you. Here is our roadmap for the next 60 minutes. First, what financial markets actually are, the real-world human definition. Second, the 3 market categories: funding, transactional, risk management. Why every dollar you earn touches all 3. Third, the key players: banks, hedge funds, governments, you. Fourth, what is changing right now: ESG, fintech, AI, emerging markets. Are you ready? Let us go. What is a financial market? Stay with me. What I am about to say sounds almost too simple, but its implications will rewire the way you see the entire economy. A market, any market, is just a mechanism for bringing buyers and sellers together. Think about your local farmer's market. Someone has too many tomatoes, someone else needs tomatoes for dinner. The market is where those 2 people find each other. The Apple App Store. Same exact idea. Developers have apps, you want apps. The App Store is the market. A financial market works exactly the same way. But instead of tomatoes or apps, the product is money. And here is the beautiful, counterintuitive truth about money. Nobody, and I mean nobody, ever has exactly the right amount. Some people have more money than they need right now. They want to put it to work. They want a return. Some people need more money than they currently have. They need to fund a business, buy a house, build infrastructure, make payroll. Financial markets are the place, the mechanism where those 2 groups find each other. That is it. That is the whole idea. Think about a farmer in Nebraska in 1850. Bumper crop of corn, more than he can sell locally, and a railroad company that needs capital to lay 500 miles of track. Those 2 people are a perfect financial match. But how do they find each other? That is what financial markets solve. Today, that same transaction happens in milliseconds across digital networks, with trillions of dollars flowing every single day. But the fundamental human need? Exactly the same as 1850. The 3 types of financial markets. Financial markets fall into 3 broad categories. Once you understand these 3 buckets, everything else clicks into place. 1. Funding markets. The capital engine. Funding markets, also called investment markets, match people who have surplus money with people who need money. Think stocks, bonds, loans, mortgages. When Apple issues new stock to raise capital for R&D, that is a funding market. When the U.S. Treasury issues bonds to fund the federal budget, funding market. When your bank approves your home loan, funding market. 2. Transactional markets, the commerce engine. Transactional markets facilitate immediate business needs. The most powerful example? Foreign exchange. Right now, as we sit here, over $6 trillion is being traded in currency markets every single day. Every time a U.S. company buys parts from Germany, they need euros. Every time a Japanese tourist visits New York, they need dollars. That is transactional finance. Risk management markets, the insurance engine. Risk management markets exist for one purpose: to let you control your exposure when things go wrong. Insurance is the most familiar form, but the bigger story is derivatives, financial instruments whose value is derived from other assets: options, futures, swaps, forwards. These three markets, funding, transactional, risk management, are the three pillars of the entire global financial system. Everything else is a detail. Are you following this? Because here is where it gets personal. Your 401k? That money sits in funding markets, stocks and bonds working to generate returns for your retirement. Your international vacation last year? The moment you exchanged dollars for euros, you participated in the transactional market. Your homeowner insurance, risk management market. You are already a participant in all three. The question is, are you a conscious participant, or are you just being carried along by forces you do not fully understand? Take 5 seconds. Think of one financial product in your own life: a savings account, a stock, a mortgage. Which of these three markets does it belong to? Funding markets, where capital is born. Let us go deep on funding markets. This is where most of your money lives, and most people have only a surface understanding of how it actually works. Equity: you own a piece of the story. When a company sells stock, they are selling ownership. Every share you buy is a tiny piece of that company. You participate in its future, both the triumphs and the catastrophes. You never get your principal directly back. To get your money out, you have to sell to someone else. That is why secondary markets matter so much. The NYSE, NASDAQ, these are secondary markets. You are not buying Apple stock from Apple, you are buying it from another investor who bought it before you. In 1997, a school teacher in Ohio invested her entire savings in a little-known online bookstore called Amazon. Her financial advisor told her she was out of her mind. She held that stock through the dot-com crash, through 9/11, through 2008. 20 years later, she retired a millionaire. Not because she was brilliant, because she understood what equity ownership means: a permanent stake in a company's future earnings power. Debt: the other side of the balance sheet. Debt means I borrow money from you. I promise to pay it back at a specific future date, and I pay you interest along the way. No ownership, no vote, just a contractual obligation. Loans: a negotiated agreement between a borrower and a lender. Your car loan: a company credit line with its bank. These are bilateral, just two parties, and historically non-transferable. Bonds: a bond is transferable debt. Instead of borrowing from one bank, a company or government issues bonds, IOUs, to thousands of investors at once. U.S. Treasury bonds are the most famous example. When the government needs money, it auctions Treasury notes and bills. Institutional investors, foreign governments, pension funds, they all pile in. Money market instruments equal short-term debt under 1 year. Capital market instruments equal long-term debt over 1 year. A 3-month Treasury bill, money market; a 10-year Treasury note, capital market; a 6-month certificate of deposit, money market. Government and sovereign debt. Governments cannot issue equity, they can only borrow, and they borrow at massive scale. Their bonds set the baseline risk-free rate against which every other investment is measured. When Treasury yields move, the entire financial system moves with them. Short-term funding tools. Companies constantly manage cash flow gaps. Payroll is due Friday, but the big client pays in 60 days. Short-term tools bridge those gaps. Overdrafts, invoice discounting, factoring, commercial paper, certificates of deposit. These are the hydraulics of the business world, invisible until they seize up. Primary versus secondary markets. In both debt and equity markets, there is a key distinction between primary and secondary markets. The primary market is the market in which new debt or equity securities are issued. New bonds or stocks are sold to investors, and the issuing entity receives the sale proceeds. To ensure funding targets are achieved, issues may be underwritten by one or more financial institutions, which guarantee a certain minimum price for the securities. If end investors do not provide this price, the underwriters step in to make up the difference. The fees for this guarantee are deducted from the proceeds. Alternatively, issuers that are confident of selling their securities at a good price may choose simply to auction them, with the proceeds of the sale determined by investor demand. The secondary market is the market in which previously issued securities are bought and sold. Securities may be transferred between investors without any reference to the initial issuer. For instance, most stock exchange transactions take place in the secondary market, with shareholders transferring securities among themselves. Primary market, where new securities are created and sold for the first time. Secondary market, where existing securities are bought and sold among investors. When Tesla does an IPO, initial public offering, that is a primary market event, Tesla receives the cash from new investors. Every trade of Tesla stock after that, secondary market, Tesla sees none of that money. The secondary market serves a crucial function, liquidity. Without it, who would ever invest in a 30-year bond? The secondary market gives you an exit. To ensure funding targets are achieved, issues may be underwritten by financial institutions. These underwriters guarantee a minimum price for the securities. If investors do not provide that price, the underwriters step in. Their fee is deducted from the proceeds. Capital structure. The corporate DNA. Every company has a mix of debt and equity. That mix is its capital structure. Equity is at the top of the risk ladder, highest potential upside, but last to be paid if the company fails. Senior debt is at the bottom, lowest risk, first paid in bankruptcy, but lowest return. In between, subordinated debt, preferred equity, convertible bonds, each with its own risk-return profile. Understanding capital structure tells you exactly where your money sits in line when things go wrong. And in this business, things always eventually go wrong somewhere. We just covered a lot of ground. Stay with me, because the next section is where things get really exciting. We are talking about the market that never sleeps, processes $6 trillion a day, and directly impacts the price of everything you buy. Transactional markets, the global money machine. Foreign exchange, the biggest market on earth. The foreign exchange market, FX or Forex, is the largest financial market in the world. Over $6 trillion every single day. The entire U.S. stock market, NYSE and NASDAQ combined, trades about $400 billion on an average day. The FX market does 15 times that. Daily. Around the clock. 5 days a week. And here is the wild part, financial market professionals now dominate it. It is estimated that less than 10% of daily FX volume involves actual transactions by non-financial businesses. The other 90%? Banks, hedge funds, speculators. The three dominant currency pairs are UR-USD, USD-JPY, and GBP-USD. More than half of all FX trades involve just these three pairs. In 1992, a hedge fund manager named George Soros decided the British pound was overvalued relative to the German mark. He built a massive short position against sterling. When the Bank of England failed to defend its currency, the pound crashed out of the European exchange rate mechanism. Soros made over $1 billion in a single day. He did not manufacture anything. He did not provide a service. He read the market correctly, and the FX market paid him handsomely. Trade finance, the invisible backbone of global commerce. Every product you are wearing right now, your shoes, your watch, your phone, almost certainly crossed multiple international borders to reach you. How does that actually work from a financial standpoint? Here is the fundamental tension in international trade. The exporter wants to be paid before they ship. They do not know this foreign buyer. What if they never pay? The importer wants to pay after they receive the goods and verify quality. What if the shipment is defective? This is the classic standoff. And banks solved it centuries ago. Letters of credit, bank guarantees, document negotiation. Banks step in as trusted intermediaries, vouching for both sides and facilitating the transaction. Without trade finance, global commerce as we know it would collapse overnight. Commodities, the foundation of everything. Commodities are raw or partly refined materials that are used to make the products we use every day. Large markets facilitate trading in a wide range of commodities, from agricultural goods to energy and metals. Most agricultural commodities can be divided into three broad groups or complexes. The grains complex includes commodities such as corn, wheat, rice, oats, and soybeans. The livestock and meat complex includes live cattle, feeder cattle, and lean hogs. The soft commodities complex includes sugar, cocoa, coffee, orange juice, and cotton. There are significant energy trading markets for products such as crude oil and heating oil, natural gas and liquefied natural gas, electricity, and coal. There are also commodities markets for many different types of metal, including precious metals such as gold, silver, platinum, and palladium, and non-ferrous metals such as copper, aluminum, tin, nickel, zinc, and lead. Other traded metals include iron ore, steel, and cobalt. New commodities markets are emerging all the time. For instance, there are now markets for carbon and sulfur emissions, weather products such as temperature derivatives, wet and dry freight, and cryptocurrencies. Commodities markets can be seen as transactional as they allow end users such as manufacturers or distributors to purchase the materials they need from a market featuring the offerings of numerous producers. However, as with foreign exchange markets, commodities markets also serve investors and speculators. Commodities markets trade the raw materials that make everything else possible. Grains, corn, wheat, soybeans, the calories that feed the planet, energy, crude oil, natural gas, electricity, the power that runs civilization, metals, gold, silver, copper, aluminum, the building blocks of technology and infrastructure. And new commodity markets are constantly emerging. Carbon credits, weather derivatives, freight indexes, cryptocurrency. The definition of commodity keeps expanding as the economy evolves. We are past the halfway point. Take a breath. You are doing great. What we have covered so far is the infrastructure of global finance. Now let us talk about the tools that let you manage the risk embedded inside that infrastructure. Risk management, controlling the uncontrollable. Risk is not optional. Every financial position you take carries risk. The question is not how to eliminate risk, because you cannot. The question is how to manage it. Insurance, the one everyone knows. You already understand insurance intuitively. You pay a premium. In exchange, if something bad happens, someone else absorbs the financial loss. What most people do not know is that there are financial insurance products, companies that specifically insure bond payments. If a bond issuer defaults, the insurance company pays out instead. This played a massive controversial role in the 2008 financial crisis. Derivatives, the power tools of finance. Derivatives are financial instruments whose value is based on or derived from the value of some other instrument known as the underlying. Derivatives facilitate risk management by giving certainty as to future costs or revenues and setting maximum or minimum values for key variables. Derivatives reference nearly every possible underlying in finance. Although commodity and agricultural derivatives markets remain significant, they are dwarfed by the markets for derivatives covering key financial variables such as interest rates, exchange rates, equities, and credit. With most derivatives, there is little or no requirement to use cash upfront, and most derivative contracts can be liquidated or closed out before the need for an actual purchase. This allows traders and speculators to benefit from leverage. They can generate returns based on the performance of the underlying with no cash outlay. An important caveat, however, is that most derivatives transactions require some form of collateral payment to cover the credit risk associated with the future transaction. Because derivatives mimic the price movements of other assets, they are widely used as speculative instruments as well as for risk management purposes. There are 4 fundamental types of derivatives. Learn these. They appear everywhere in modern finance. Options, the right without the obligation. An option gives you the right but not the obligation to buy or sell an asset at a predetermined price on or before a future date. Call option equals right to buy. Put option equals right to sell. Think of it like a security deposit on a house. You pay a small fee to lock in today's price. Prices go up, you exercise your right to buy at the old price. Prices go down, you walk away and only lose the deposit. Forwards, the private contract. A forward is a customized private agreement to buy or sell an asset at a future date at a price agreed today, most commonly used in currency markets. Example, a US company knows it needs to pay a European supplier 10 million euros in 6 months. It enters a forward contract today to lock in the exchange rate, no matter what happens to currencies in the interim. Futures, the standardized forward. A futures contract is a standardized forward traded on organized exchanges with uniform contract sizes, delivery dates, and specifications. Because they trade through clearinghouses, futures have significantly less counterparty risk than forwards. Classic example, airlines buy oil futures to lock in fuel costs. That is exactly why Southwest Airlines profited when oil prices spiked in the mid-2000s. They had hedged aggressively with oil futures. Swaps, the exchange of cash flows. A swap is an agreement to exchange cash flows at specified future dates. Nothing is bought or sold, just payments are exchanged. Most common type, interest rate swaps. A company has a variable rate loan and wants cost predictability. It swaps with a counterparty, paying a fixed rate, receiving a variable rate. Suddenly, interest costs are locked in and predictable. Credit default swaps, CDS, function like insurance on bond defaults. They were at the absolute center of the 2008 financial crisis. Most derivatives require little or no upfront cash. A small move in the underlying can generate enormous gains or catastrophic losses. Derivatives are power tools. In expert hands, they manage risk brilliantly. In ignorant hands, they blow up portfolios and entire firms. Who are the players? The major players in every financial market. Banks play multiple roles in different markets. Within a single country, there may be many types of banks. Likewise, within a single bank, there may be many different business lines. In the simplest case, banks take deposits from individuals or institutions and make loans. This is known as commercial banking. Alternatively, or additionally, banks distribute debt and equity securities in both primary and secondary markets. This is known as investment banking. An investment bank may act as an underwriter, guaranteeing proceeds for an issuer, a broker, serving as an agent between buyer and seller, a market maker buying or selling securities from customers and holding inventory. Banks are also significant borrowers in their own right. If customer deposits are insufficient to support their lending businesses, banks will borrow from bond or money markets. Banking concentration varies from country to country. For instance, there are many banks in the US but far fewer in Europe. Some banks operate internationally with huge volumes of cross-border business. And in some countries, the most important banks may be foreign-owned. Non-bank financial firms such as asset managers are important participants in financial markets involved in trading, investment, and other activities. In addition, various non-bank entities are increasingly offering traditional banking services. For instance, some institutional investors may enter direct lending relationships with borrowers. Retail investors may deposit cash in short-term investment funds rather than with conventional banks, and non-bank financial technology firms that offer payment services have made significant inroads into the consumer banking/payment space. Further, some fintech firms offer other banking services, including loans and FX facilities. Shadow banking, the Wild West. Shadow banking refers to credit intermediation happening outside the traditional banking system through entities not subject to bank regulation. Private credit funds, money market funds, peer-to-peer lenders, fintech payment platforms. Shadow banking provides real value, more competition, more credit availability, but it creates systemic risks that regulators struggle to monitor. This tension is one of the defining challenges of modern financial regulation. Institutional investors, the big money, pension funds, insurance companies, mutual funds, hedge funds, sovereign wealth funds. These are the most important suppliers of capital in securities markets. By aggregating money from millions of individuals, they can invest in ways no single person could, moving billions in a single trade, accessing private markets, investing globally across every asset class. Corporates. Private sector companies are important players in debt markets. Rather than diluting ownership by issuing equity, companies may prefer to fund themselves with debt. Further, while generally borrowers, some corporates may have investable surpluses. The term corporates covers a range of entities with different objectives and requirements. This table breaks down 3 types of corporate clients in banking, comparing them by size, structure, and financial needs. The first group is multinationals and large domestic corporates. These are the biggest players, companies with sales greater than $1 billion. They're large, listed companies that can operate in a single country across multiple regions or even globally. In some cases, these domestic corporates might be state-owned enterprises or monopolies. Because of their scale and complexity, their financial needs are quite broad. They typically need access to capital markets, hedging, foreign exchange management, cash management, trade finance, and loan or overdraft facilities. The second group is mid-sized corporates. These sit in the middle, with annual sales somewhere between $50 million and $1 billion. They are companies or corporate groups that may be listed on a stock exchange but aren't quite at the multinational level. Their financial needs are somewhat simpler. They mainly focus on working capital and asset finance along with foreign exchange, trade finance, and cash management. The third and final group is small and medium enterprises, or SMEs. These have sales of up to $50 million, though a large portion of them actually bring in less than $1 million per year. Structurally, many SMEs are sole traders, partnerships, or family-owned businesses, while the larger ones among them may have more formal corporate setups. Their financial needs center around working capital and asset finance, plus foreign exchange and trade finance, especially for businesses involved in import and export. Governments and sovereigns, the biggest borrowers. Governments cannot issue equity, only debt, and they borrow at massive scale. Government bonds set the risk-free rate, the benchmark against which all other investments are measured. When treasury yields move, everything in finance moves with them. You, the individual investor. Collectively, individuals represent the largest segment of most financial markets. Peer-to-peer lending, fractional shares, direct indexing. These innovations are rapidly closing the gap between institutional and retail investors. The gap between what institutional investors know and what retail investors know is closing, but it has not closed yet. That gap is exactly why you came here today. This section is about regulators and regulation in financial markets. The key idea is that markets can't function properly without rules. So financial regulators exist to keep things running smoothly, and their work generally falls into three main areas. The first area is building stronger financial institutions. This is called microprudential regulation, which basically means looking at individual banks and financial institutions one by one, making sure each of them is safe, healthy, and operating soundly on their own. The second area is ensuring sound markets. This type of regulation is focused on how markets behave overall. The goal here is to promote fairness and transparency, making sure the playing field is level for everyone. It also involves cracking down on trading practices that could distort the market and working to reduce credit risk and other types of financial risk. The third area is maintaining financial stability. This is called macroprudential regulation, and unlike the first type, this one zooms out to look at the big picture, the health of the entire financial and economic system. Regulators in this space fine-tune things like credit policy to reduce or remove what's called systemic risk, meaning risks that could bring down the whole system, and to keep overall stability intact. So in short, regulation works on three levels: the individual institution, the market as a whole, and the broader economy. We are almost at the finish line, but I need to tell you about the forces that are reshaping everything we just discussed. Because the financial system is not static. It is being torn apart and rebuilt in real time. The forces reshaping financial markets. The 2008 financial crisis, the system near-death experience. We cannot discuss modern financial markets without the global financial crisis, the GFC of 2007 to 2009. Mispriced risk in U.S. subprime mortgages. Derivatives layered on top of derivatives. A collective belief that housing prices could only go up. When that belief collapsed, so did much of the global financial system. Numerous institutions failed. Governments bailed out too-big-to-fail banks at enormous taxpayer cost. The aftermath gave us Basel III, sweeping new capital, liquidity, and leverage requirements for banks. Derivatives reform. New macroprudential oversight. Every rule and requirement in modern banking traces back to 2008. ESG, the values revolution. Environmental, social, and governance investing, ESG, has gone from a niche concept to a multi-trillion-dollar force reshaping capital allocation worldwide. Institutional investors are no longer just asking what is the return. They are asking, what are the climate risks? What are the labor practices? Is the governance structure sound? Tens of trillions of dollars in assets now have explicit ESG mandates. Fintech and AI, the technology revolution. Blockchain, artificial intelligence, algorithmic trading, digital payments, decentralized finance. The financial industry is being disrupted faster than almost any other sector. AI is already processing loan applications, selecting trading strategies, detecting fraud, and managing risk models. The financial professionals who will thrive in the next decade understand both traditional market mechanics and the technological forces rewriting the rules. The rise of emerging markets. China, India, Southeast Asia, Sub-Saharan Africa. The center of gravity of the global economy is shifting. Emerging market equities and debt are no longer exotic. They are mainstream asset classes in every major institutional portfolio. As demographic and economic trends play out over the next 3 decades, capital will increasingly flow toward these dynamic, growing economies. The investors who understand and position for this shift early will have an enormous advantage. Liquidity. Liquidity is a key concern in financial markets. Can market participants buy and sell desired volumes of securities or other products without unduly moving prices? To increase liquidity, successful markets must coordinate the buyers and sellers of individual products. Sometimes markets concentrate buyers and sellers in a single system, other times transactions take place through a dispersed network. Even where the setup is similar, however, differences in underlying economic fundamentals will generate very different market liquidity characteristics. The stock exchange in Lagos is not comparable to that in New York. Exchange trading versus OTC trading. Trading generally occurs in one of two ways. In an exchange-traded market, a central entity, the exchange, provides facilities for transactions to be executed and outlines the rules and regulations around these transactions. All market participants have access to the same prices for any products listed on the exchange and must report any trades to the exchange. Order books are generally visible to all participants. While exchanges trade nearly all financial products, they are most influential in equity and certain derivatives markets. Historically, exchanges had a specific geographic location, but they increasingly operate via digital networks. Today, exchanges are more like data centers than the traditional image of a bustling trading floor. The development of electronic trading has seen the rapid growth of exchanges such as BATS-CX Europe. At the same time, exchange groups are consolidating. BATS-CX Europe is itself the result of a merger, while the New York Stock Exchange NYSE is part of a multinational conglomerate, the Intercontinental Exchange IC. OTC trading. Many markets such as FX and bonds are dominated by over-the-counter OTC trading. In an OTC market, financial transactions take place through private negotiation between counterparties rather than on a centralized exchange. Participants in search of the best price must seek out and choose between multiple providers. Parties in the OTC market can be located anywhere so long as they can contact each other. Historically, deals were negotiated by telephone, and while that remains the case for some products, electronic OTC trading is growing fast. Regulation is making the exchange-traded OTC distinction less clear. As regulators push for market transparency, some products, notably swaps and other derivatives that were formerly traded on a private bilateral OTC basis, must now be traded on a multi-seller network with central clearing and reporting. Dark pools. Dark pools are electronic platforms where participants can execute transactions with no pre-trade transparency. In contrast to traditional lit exchanges, dark pools do not display order books. Orders are anonymous and are not displayed prior to execution. Most dark pool trades are large block trades conducted by financial institutions, but smaller trades are increasingly common. Critics of dark pools accuse them of reducing market liquidity and obscuring price transparency, and regulators in many countries have introduced curbs on their activities. Public versus private markets. Securities don't need to be listed and traded on a public market. Some entities choose not to offer equity to the general investing public at all. Instead, equity transfers are conducted through private negotiations in an industry known as private equity. Similarly, some entities may choose to sell bonds outside of the public market through a private placement to specific investors. Financial centers. New York, London, Tokyo, Shanghai, Singapore, and Hong Kong have long topped the list of global financial centers, locations with a high concentration of financial institutions and market participants. Although technology allows financial professionals to operate from virtually anywhere, large financial institutions value a healthy supply of skilled employees and established infrastructure and, therefore, tend to concentrate in major cities. To some extent, a city's importance may simply be a historical legacy. However, once the process of concentration has taken root, it becomes self-fulfilling. Nevertheless, the rankings are not set in stone. The rapid growth of the Chinese economy, for example, is reflected in the growing importance of various Asian financial centers. Let me take you back to where we started. That discomfort you felt when I asked if you really understood where your money goes? That discomfort had a name. It was called uncertainty, and uncertainty in financial markets costs you money. Every year, every decade, across your entire financial life. Today, you got something real. The architecture of the entire financial system, funding markets, transactional markets, risk management markets, the key players, banks, institutional investors, shadow banking, governments, and yourself. The tools, stocks, bonds, derivatives, foreign exchange. The forces reshaping everything: ESG, AI, fintech, emerging markets, post-GFC regulation. Here is your 5-second rule moment. In the next 5 seconds, before your brain talks you out of it, decide on one specific thing you are going to do differently with your financial knowledge starting tomorrow. Rebalance a portfolio. Read a prospectus. Ask your advisor about derivatives exposure. Anything. Just start. The market does not wait for you to be ready. But now, you are a little more ready. Thank you.